Thank you for listening to our online tutorial on credit scores. If you are like most people, you probably have never seen your credit report or know your credit score. It's only when applying for a mortgage do you find out how important it is to have a good credit score. Over the life of your mortgage, a good credit score can save you tens of thousands of dollars. Credit scores are very important to lenders since it predicts the probability of defaulting on your debts within the next 2 years. For mortgages insured through the Canadian Mortgage and Housing Corporation, or CMHC, you need a minimum credit score of at least 600 to qualify. This isn't a very high score, so many lenders set their own minimums. Credit scores are not only used for mortgages, they are used for any other type of credit such as a car lease, credit cards, and lines of credit. There are 2 credit bureaus in Canada, Equifax and TransUnion. They keep records of your debts and repayment habits. They also produce a credit score. In British Columbia, most lenders and brokers use Equifax. Here's what you'll find in your credit bureau. You'll find the names of all of your creditors. This could be credit card companies, bank lines of credit, car loans, and leases. The report will indicate your credit limits, balances, monthly payment amounts, and missed payments. If you've missed payments, the length of time you missed the payment will be indicated. Note that most banks don't report mortgages to the credit bureau. The only mortgages you'll see are those issued by credit unions or mortgages that are set up as a home equity lines of credit. Whenever you apply for credit, the lender will want to view your credit report. This is an inquiry, and all inquiries to your credit report will be indicated. Bankruptcies, collection items, and consumer proposals are indicated on the bureau as well. Personal information such as name, address, employment, and social insurance numbers are indicated on your credit bureau. How is your score determined? There are 5 factors that determine your score: your repayment habits, the balances owed, the length of your credit history, the amount of new credit, and the types of credit you have. Your repayment habits is the most important factor and accounts for 35% of your credit score. It is critical for lenders to know how you manage your debts and whether you pay them on time. Here are a few tips for keeping a good credit score. 1. Always pay your bills on time. 2. Be aware that paying a collection item will not erase this from your credit bureau. 3. Older delinquencies have a lesser effect on your credit bureau. A bill missed 4 years ago will not have a significant impact on your score compared to a bill missed 2 months ago. And 4. Credit score looks at how late your missed payment is. A 60-day late is not as bad as a 90-day late. If you missed paying a debt, work hard to update it as soon as possible. The next important factor is how much you owe. This accounts for 30% of your score. High balances on your debts indicate that you may be overextended. The credit score looks at the ratio of balances to limits. So if you have a credit card with a limit of $10,000 and you've borrowed the full amount of $10,000, your score will be negatively affected. It's recommended that you keep your balances no more than 30% of the limit. If you have several credit cards, don't max out on one card and have a low balance on another card. You're better off to spread your balances evenly across all your credit cards. Maxing out a credit card is a sign of upcoming problems. Lastly, if you have unused credit cards, don't close these accounts even if you're not using it. Remember, these unused credit cards represent credit limits that are available for you to use. By closing them, you would lower your credit score. The third important factor is the length of your credit history. This accounts for 15% of the score. As you would expect, people with longer track records will have a higher score. This factor considers the age of your newest accounts, your oldest account, and the average age of your accounts. A common mistake is for people to close their older accounts and open a new account. We often get offers for new credit cards at a low interest rate and then close our long-standing credit card since you won't be using it. Don't do this. We suggest that you keep both accounts at least until you complete your financing on your home. The fourth important factor, accounting for 10% of your score, is the new credit on your bureau. Opening several credit accounts is a risk to lenders as well as making multiple applications to lenders. Your credit report will show all inquiries that have been made on your credit report over the past 2 years, but score only considers past 12 months. Here are a few tips on how to maintain a good score. 1. might shop within a short period of time. If you're shopping for a car loan or mortgage, you should shop within a 2-week period. An inquiry during this time frame is considered as just one inquiry for credit scoring purposes. You should also know there is no impact if you check your own credit report. You can check your credit score online at equifax.ca or transunion.ca. The last factor is your mix of credit. This accounts for 10% of your credit score. The score looks at types of credit you have. Be sure you have a credit card. People without a credit card are considered higher risk. The credit score does not consider your race, age, marital status, national origin, sex, where you live, employment, income, occupation, family support commitments, rental agreements. What good is a score? As mentioned previously, the legal minimum is 600, but this really isn't a good score. At this time, I would consider a score of between 660 to 680 as a decent number. If your score is over 740, it should be fine for almost all mortgage programs. As you can see from these graphs, a score of over 690 puts you in the upper 3/5 of the population. Lenders use the score to determine whether you qualify for a mortgage, at what rate, and also the amount. If you have a score of over 680, many lenders will allow you to obtain a higher mortgage. The thinking here is that you're capable of managing your credit wisely. The score isn't the only factor in determining what you qualify for. Lenders look at how long you've managed your debts. In general, they will want to see a 2-year track record of strong credit. This is because the credit bureau can sometimes be misleading when someone is new to credit. Secondly, lenders look at the reason for the low score. If the reason is due to high balances, this is lesser of an issue than if the reason for the low score was due to delinquencies. Lastly, your employment stability, the amount of down payment, the marketability of the property will have a significant bearing on your application. For those of you who do not have credit, my advice is to go and get some quickly. This is the same as bad credit since lenders have no way of gauging how responsible you are with credit. If you are a new immigrant, it's understandable that you won't have Canadian credit. Lenders will often take a letter of reference from a financial institution from your home country in place of a credit report. If you are from the US or the UK, you have an advantage since credit bureaus from these countries can be provided. If you have been through a bankruptcy or consumer proposal, you need to re-establish your credit. The sooner the better. You can start by getting a copy of your credit bureau and have it reviewed by a professional. By law, you're entitled to receive a copy. This report will not have your score. To get your score, you'll need to go online and purchase it. Once you have your credit report, you should correct any errors. I recommend that you get 2 or 3 loans or credit cards with a reasonable amount, meaning over $2,000. You may need to get a secured credit card and or a department store credit card. Don't get a prepaid card since this won't go on your credit bureau, and be sure to avoid lenders that do not report to the credit bureaus. Once you have credit, make sure you don't miss any payments. Develop a way to keep track of due dates. The sooner you start rebuilding your track record, the better. Keep checking your score every 3 months to see if your score is increasing. Remember, the score is important, but not everything. If you have a large down payment, stable job, you may be able to get a mortgage sooner. If you're going for only 5% down, you may have to wait a bit longer. Lastly, the reason for your credit problems is important. Something that's uncontrollable, such as a medical issue, is something many loan officers can understand. If you just decide not to pay, expect additional challenges in getting a mortgage. If you haven't done so yet, you should email me to request a copy of the FICO booklet. The booklet prepared by Fair Isaac Corporation is a must-read for anyone requiring a major loan within the next 6 to 12 months. I can guarantee that it will be a worthwhile investment of your time. After you read this and you still need help on developing a strategy to improve your score, please do not hesitate to contact me. One final note, good credit is an asset. It's your reputation and your lifeline in tough economic times. Make sure it's the best it can be, especially if you're planning to purchase a home. Call or email us to set up an appointment to learn how you can get the best score and the best mortgage. Thank you for listening.